everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. Thanks for joining me today. As always, this episode is for business owners out there. So why filing your business entity report matters and what happens if you don't. So let's say you started a business, filed all the paperwork, got your EIN, opened a business bank account, you're officially in business. Yay! That's great. But here's something many new business owners don't realize. Forming your LLC or corporation isn't a one-time event. Most states require you to file periodic reports to keep your business in good standing. These reports go by different names depending on where you live. You might see them called annual reports, biennial reports, statement of information, or simply entity reports. Whatever your state calls them, they serve the same purpose. They keep your state's records updated with current information about your business. And if you ignore them, your business could be dissolved without you even realizing it. So, what are business entity reports? A business entity report is a filing that provides your state with updated information about your company. It's like a routine check-in with the government agency that approved your business formation. The reports typically include basic information like your business name, registered agent details, principal office address, and the names of your members or officers. Some states ask for additional details about your business activities or ownership structure. The filing frequency varies by state. Most states require annual filings, but some, like California, require them every 2 years, while others, like Ohio, only require them every 5 years. Your report is usually due on the anniversary of your formation date, though some states may use a universal deadline for all businesses, or maybe assign deadlines based on your business name or formation month. So why do states require entity reports? They aren't necessarily trying to create more busy work. That's arguable, I suppose, but these reports have several legitimate purposes. First, they maintain accurate public records. When someone needs to find information about your business, whether it's a potential client, a vendor, or a legal party, they can access current contact information through your state's business entity database. Second, entity reports ensure the state can reach you. If there's a legal notice, a tax issue, or other official communication, the state needs to know where to send it. Third, these filings generate revenue for state governments. The fees collected help fund the offices that maintain business records and provide services to business owners. Finally, the entity reports help identify inactive businesses. If a company stops filing reports and paying fees, it's kind of a signal to the state the business may have closed or may be abandoned. All right, let's talk about the filing process. So filing your entity report is usually pretty straightforward, though the exact process will vary by state. Most states now offer online filing through their Secretary of State website. You'll log into the state's business portal, you'll locate the business entity, review the information on file, make any updates if necessary, and pay the filing fee. Some states still accept paper filings by mail, but that's pretty uncommon. You'll receive a pre-filled form with your current information on record, and you can correct it and mail it back. But in general, I vote for online. The information you'll need to provide typically includes business name, entity number, registered agent name and address, principal office address, mailing address if different, names and addresses of members, managers, directors, or officers, depending on your entity type. Most states pre-fill everything based on what's on file, and your job is really just to verify everything and correct anything that needs to be changed. So if your registered agent, your office location, or your management structure has changed during the year, the entity report is your chance to update those records officially. All right, what about filing fees? Filing fees can vary depending on where your business is registered. So on the low end, some states charge as little as $15 for LLC reports. On the higher end, other states can charge as much as $500 or more for annual reports. Some states tier their fees tied to revenue, assets, or number of shares. So like Delaware, for example, charges LLCs a flat $300 annual tax, while corporations pay based on their authorized shares. Those fees are separate from any state taxes your business owes. So even if you had no income or activity during the year, you still need to file your entity report and pay the fee if your state requires it. So budget for those fees as a routine cost of doing business and set a reminder well before the deadline so you're not caught off guard. All right, so what if you missed the deadline? What are the consequences? So failing to file your entity report creates a number of problems, starting small, but they could snowball into even the dissolution of your business. The first consequence is typically a late fee. Most states add penalties, which can be anywhere from $25 to several hundred if you file after the deadline. Next comes loss of good standing status. When your business is not in good standing, you might lose certain privileges. Some states won't allow you to file other documents, like amending your operating agreement or conducting certain transactions until you're current. Your registered agent may resign if you're using a third party. Many registered agents require businesses to stay in good standing. If you file out of compliance, that may terminate service, leaving you without the registered agent if you're outsourcing to a third party. Extended non-compliance can also lead to administrative dissolution, which means your business goes away. If you don't file for several months or years, it'll vary by state. The state will administratively dissolve your business entity. So once dissolved, you lose your liability protection, which is critical as part of an LLC, and you're no longer operating as a legal entity, which means you could personally be liable for business debts and obligations. You could also lose your business name. Once your entity is dissolved, your business name becomes available for others to register. So someone else could potentially claim the name you've been building your brand around. Bank accounts and contracts can be affected. Some banks require businesses to maintain good standing. Contracts might include clauses that trigger termination if your business entity is dissolved. So what happens during administrative dissolution? So they don't really happen overnight. States typically follow a process designed to give you opportunities to come into compliance before taking final action. First, you'll receive notices. Most states send multiple warnings to your registered agent and principal office address before dissolving your entity. And these notices explain what you need to do to avoid dissolution. And after a specified period, without compliance, the state issues a certificate or a notice of dissolution, and your business is officially terminated as a legal entity. So at this point, you can no longer legally conduct business under that name. Any contracts, licenses, or permits tied to the dissolved entity might be invalid. There can also be tax consequences. Some states treat administrative dissolution as a taxable event or require final tax returns. So talk to a tax professional about your situation if that's happening to you. The dissolved entity might still be liable for debts and obligations that existed before dissolution. So that doesn't mean your responsibilities and debts go away. All right. So how do you reinstate a dissolved business? Let's say this happened. How do you get your business back? You can usually bring it back to life through a reinstatement process, which typically involves filing all past due entity reports, paying all outstanding fees and penalties, and submitting a formal reinstatement application. Some states offer retroactive reinstatement, which restores your business as if it were never dissolved. And this can be valuable because it maintains your formation date and preserves continuity. Other states only allow prospective reinstatement, meaning your business is considered dissolved during the gap period, even after reinstatement. So the costs of reinstatement can add up. You'll pay annual report fees you missed, late penalties, which can compound based on how many years gone by, reinstatement fees, and potentially expedited processing fees if you need quick reinstatement. So for example, if you let your California LLC lapse for 3 years, you'd owe $800 for each year franchise tax, plus $250 for each statement of information, penalties and interest, plus a reinstatement fee of $250. You could easily be looking at over $3,000 just to reinstate. And then time limits may apply. Some states only allow reinstatement within a certain window after dissolution, often between 2 and 5 years. After that, you might be forced to form a whole new entity. So the reinstatement process can take several weeks or even months in some states. And during that time, you're technically not operating as a valid business entity. So what are some best practices for staying compliant? Simplest way is just to stay on top of filing. Make sure you file every year or whatever that time period is in your state. Set up calendar reminders. Pay attention to the emails you get. Be sure you don't let those go to spam. Consider using a third-party registered agent that can include compliance monitoring that handles this stuff for you. Keep your contact information current with the state. If you move or change email addresses, make sure you update things immediately so you get the notices. And review everything carefully before submitting. Don't just click through and assume the pre-filled information is correct. Also, be sure you keep confirmation receipts and time-stamped copies of submissions, usually via email. And that way you've got proof if you ever need to show those. And just budget for those fees. Make sure you plan for those compliance fees. And if you operate in multiple states, be sure you track the requirements for each state separately as well. So know when to get professional help also. Generally, this is pretty straightforward, but sometimes it makes sense to bring in a professional, whether it's as simple as hiring a third-party registered agent or a tax pro or an attorney. Professionals like this can help you stay on top of these requirements and make sure you're filling out everything properly and checking all the boxes you need to stay active as a business entity. So your entity report is just basically a part of business maintenance. Growing your business is fun, it's exciting, but it's really essential that you keep your business active. Establish a good system and a routine for making sure you keep these reports active and filed on time. So super important to make sure we don't want your business to be dissolved. So again, it's very simple, pretty low cost. If you stay on top of business entity filings, your business will stay active and you won't have these problems. So, all right, with that, as always, you know where to find me. I'm on the web at elevationfinancial.com. And you're always welcome to reach out through my website or any social media properties I'm on. Or if you'd like to chat in real time, or maybe even learn about becoming a client, you can book a free consultation on my website at elevationfinancial.com. Thanks for joining me today, as always. Have a great day. We'll see you next time.